Okay, let's dive right into our investigation of Southern Company. We're going to put this massive utility under the microscope and figure out if it's a solid, defensive investment or maybe just a popular name with a pretty high price tag.
And really, this is the big question we're trying to answer today. Is the stability that a company like this offers actually worth what the market is asking for right now? Or are investors simply paying way too much for a little bit of safety? Well, let's find out.
So, first things first, let's open up the case file and get a handle on what exactly Southern Company does. You got to know the business model before you can analyze anything else, right?
At its core, this company is an absolute giant in the American energy world. And their business model, well, it's pretty simple and it hasn't changed much in decades. They build all that essential infrastructure we all depend on, and in return, they earn a predictable, government-regulated return on that massive investment.
See, this whole business is built around one central idea: stability. I mean, think about it. They provide electricity and gas, and because those are essential, demand is incredibly consistent. We all need to keep the lights on, right? And that makes Southern Company a classic defensive business, which helps shield it from a lot of the wild ups and downs you see in the rest of the economy. All right, now that we understand the business, let's head into the evidence room. It's time to pop the hood, examine the financial clues, and see what the numbers are really telling us.
Okay, so the first piece of evidence is a huge strength for the company. Southern Company basically operates as a regulated monopoly in its territories. I mean, it's pretty much impossible for a competitor to come in and build a whole new set of power lines and substations right next to theirs. This creates what you call a very, very strong competitive moat. But, the evidence isn't all good. The analysis flags some pretty big concerns, especially when you look at their cash and their debt. The company actually has a negative free cash flow of over $1.8 billion. That means it's spending more cash than it's bringing in. So how does it pay its dividend? Well, it's forced to take on more debt or issue new stock, and that can definitely add risk for investors down the road.
And this brings us to, well, a really crucial part of our investigation: the price. The valuation metrics we're looking at suggest the stock is just plain expensive, especially when you stack up its price against its pretty slow growth prospects. So let's break this down a bit. A price-to-earnings ratio, or PE, of over 24, that's really high for a slow and steady utility. Investors usually aren't willing to pay that kind of premium for slow growth. And these other metrics here, the PEG and the PEGI, they just confirm it. They factor in that slow growth and the dividend, and they're both way above a level that would scream good value. Basically, all the clues are pointing in the same direction. The stock looks pricey.
Okay, with all the financial evidence laid out, it's time for a proper risk assessment. Let's weigh the company's strengths against its weaknesses, and then game out a few potential futures.
What's interesting here is that the analysis gives the heaviest weight to that regulated monopoly. That's its biggest strength for sure. But look at this. Its key weaknesses, like the constant need for cash and its high debt, are weighted just as heavily as its revenue stability. So this really paints a picture of a strong company, yes, but one that is also carrying a lot of leverage.
And this kind of illustrates three possible ways this story could play out. You have the bear case, where interest rates rise and hurt the stock, putting its value around $65. Then there's the bull case, maybe driven by faster growth from things like electric vehicles, which suggests a value closer to $88. But really, the most likely path is this base case right in the middle, which assumes things just keep chugging along, with steady, slow growth. And that points to an intrinsic value of about $77 a share.
So, based on all of this evidence, what is Southern Company actually worth? Let's get to the bottom line and figure out what the right price to pay really is. Now, to get a more reliable number, the analysis doesn't just use one method. It's smarter than that. It blends two different valuation models, a discounted cash flow and a modified earnings value. By averaging them out, it lands on this final blended intrinsic value of $77 per share. And here it is. This is the absolute core of our investigation. We have an estimated worth of about $77, but the stock is currently trading out on the market for $97. That's a huge 20% gap between what the company seems to be worth based on its fundamentals and what people are actually paying for it. Now, the analysis isn't just looking for any old return. It has a very specific goal in mind. The objective here is to get at least a 9% average annual return over a 16-year period. So the question becomes, what price makes that specific goal possible?
This table is incredibly useful because it basically works backward from that 9% return target. And it shows that to hit that goal, your purchase price has to be way lower than where the stock is today. For a long-term 16-year investment, the analysis shows you'd need to buy the stock at or below $70 a share. So, after reviewing all the evidence, the business, the financials, the risks, the valuation, what is the final verdict on Southern Company? Let's wrap this case up.
This quote from the analysis really sums it up perfectly. The business itself, it's solid, it's stable, it's predictable. Everything you'd want from a utility. The problem isn't the company, the problem is the price. The current valuation is just too high compared to what it seems to be intrinsically worth.
So the crucial point is this. The final recommendation is to hold the stock, if you already own it, for that steady dividend income. But for anyone looking to buy, the advice is pretty clear. Wait. Wait until the price becomes a lot more attractive. Specifically, somewhere below that $70 mark.
So, to sum up our entire investigation, Southern Company is a good company with a powerful, protected business, no doubt about it. But there are red flags, like the high debt and a valuation that's way above its intrinsic worth. And all that suggests that at its current price, it's just not a compelling buy for new investors who are looking for strong returns.
And that wraps up our deep dive on Southern Company. The evidence suggests it's a quality business at a pretty questionable price. So now, I'd love to hear from you. What company do you want us to put under the microscope next? Let us know in the comments.